In the world of economics, velocity of money refers to the rate at which money is exchanged in an economy. In your personal finances, it refers to how often you are able to make or recover money and use it over again. It's a very similar measurement, just applied in a different way. And we'll talk about this more in a minute. As an economic statistic, velocity of money is usually measured and reported as a quotient of the gross domestic product, or GDP, divided by a country's M1 or M2 money supply. High velocity of money is usually associated with a strong economy, while low velocity of money usually concurs with recessions and depressions because goods and services are not moving as fast. Here's the formula. Velocity of money equals GDP divided by the money supply, M1 or M2. And that's where M1 is the narrowest measure of the money supply, comprising the currency in circulation plus the demand deposits or checking account balances. M2, on the other hand, is comprised of the M1 money supply plus net time deposits other than large certificates of deposit. Now here are some historical graphs of the velocity of money in the U.S. economy based on the M1 and M2 money supply. As you can see, we are near historic lows in 2021. This is not a good thing because a higher velocity of money usually means more goods and services are being exchanged, which creates greater wealth for everyone. Lower velocity of money indicates not as much value exchange or wealth creation. Now, you can't do a lot to change velocity of money in the national economy, but you do have control over the velocity of money in your personal economy. Many people don't think about velocity of money on a personal level. They see money they make, money they spend, money that they save or invest. Sometimes they pay interest to banks or other financial institutions, but they don't usually recognize the velocity of money or the volume of interest which is inherently at work in these types of transactions. Volume of interest is the total interest paid on a loan divided by the total payments. Volume of interest is usually higher than the annual percentage rate. For example, on a $250,000 mortgage, 5% interest amortized over 30 years, payments are $1,342.05 per month. So if we wanted to figure the volume of interest on this, we would take that payment amount times 30 years, 12 months a year, that's 360 months. That gives us the total payments, $483,139 and a few odd cents. So there's our total payments. Now if we subtract the original principal, we can get total interest, $233,000 and some odd dollars and cents. So to figure the volume of interest is easy. We take the $233,000, divide by the $483, and that tells us the volume of interest is 48%. And it tends to be higher with long-term loans, such as a 30-year mortgage like this, or if you're making minimum payments on credit card balances. Now, if we take a long-term loan and refinance it early, the volume of interest becomes even higher. For example, refinance the same $250,000 30-year mortgage after 5 years, and your volume of interest is almost 75% because most of the interest is paid in the early years of an amortized loan. Here's the math. The payment is still $1,342.05 per month. You make 60 of those payments. The first 5 years, you've paid over $80,000 on this loan. Now, if you look at the amortization schedule for the loan, only $20,000 and some odd dollars and cents went to principal. That means you paid $60,000 in interest in the first 5 years. $60,000 divided by $80,000, over 75% volume of interest. Now, banks don't mind people taking a long time to pay off a mortgage because they know they'll make money on the volume of interest. But if they suddenly need more capital to make a better loan or another investment with a higher rate of return, they would like the loan to be paid off faster in order to use that money over again. That's velocity. When a loan is paid off faster, the volume of interest goes down, but the velocity of money goes up, creating an opportunity to add more value in your life in another way. Many people recognize the value of compounding interest over time, but they invest through financial tools which lock their money away, so they can't use it for most of their lifetime. They're missing out on great opportunities for improving velocity of money. There is a better way. By keeping money in participating whole life insurance products, specifically designed to provide death benefit protection and also liquidity in the form of high cash values, you can create great opportunities for improving the velocity of money in your own life. Here's an example of how this can work. You have the velocity of money, you funded a life insurance policy. Let's say that you have $20,000 cash value with the insurance company. Well, the insurance company will give you a loan for $20,000 of the cash value. You'd need a little bit more than that because they'll save out interest for the first year in advance, but we'll show that being paid at the end of the year here. So the $20,000 now comes over to the money manager account. The only thing special with this account is it's separate from your everyday personal checking account, so the money doesn't get mixed up with your everyday expenses. Now, what can you use this $20,000 for? Let's say you have a credit card at 17% interest. You could use this $20,000 to go pay off the balance on that credit card and then pay yourself whatever you were paying on the credit card. Let's say that was $500 a month because you were planning to pay that credit card off over the next 5 years. That's how long it would take. But if you pay yourself back the $500 a month for the 5 years back to the money manager account, then in 6 months down the road, 6 times $500 a month gets you $3,000 back in the money manager account. Now, let's say that you own a business and you could purchase a piece of equipment for $3,000. But if you buy it, that would be the cost if you buy it over time, $500 a month over 6 months. But if you buy it now, they'll give you a 10% discount, so it's only $2,700. Well, you could save $300. That's a good saving. So you do that. You pay the money manager account back what you would have had to pay to the company if you bought it over 6 months. So 6 months from now, we now have $1,000 a month coming into the money manager account. How much are you going to have back in the money manager account? Well, there's still $300 left over. So $1,000 a month for another 6 months, $6,300 is now in the money manager account by the end of the year. 12 months from when we started this. Now, this is where the insurance company is going to need a year of interest on your original $20,000 policy loan. If that interest rate was 5%, that's going to be $1,000 of interest for the year. So you can obviously get this from the money manager account. That leaves you with $5,300. And let's say that you decide to go on vacation. So you spend the $5,300 to take your vacation. And you're going to pay that loan back. You amortize it just like you would have had to pay a bank loan back if you had taken a bank loan or used a credit card to take this vacation. You're going to pay it back at 6% interest, $235 a month, because you'd like to pay it back over 2 years. But we haven't done that yet. We're just 12 months in. Let's see what has happened so far. If we look at velocity of money, that would be the money that's used divided by the money that is in circulation here. There was a $20,000 that we started with, right? So the original $20,000 is what we used. We also used $2,700 of that over again, and then another $5,300 of that over again. So we've used $28,000. So $28,000 divided by the $20,000, that's going to give us a percentage. It would be a 40% increase in the velocity of money. So that's a big increase. That's a velocity of money at work for you. You've been able to use the same money over again in the same year. Now, if we look at volume of interest that's connected with this, there's $3,188 that you saved on the credit card. So you made that money since you were able to recover that. Here's the amortization schedule that backs this up. You can see the interest and principal breakdown for each monthly payment in the first year there. And then here for the second purchase, you saved $300. That one's easy. And you haven't saved anything yet on the vacation because you haven't made any repayments on that. So the volume of interest you recovered is $3,488 for the first year, minus the interest that you paid to the insurance company of $1,000. So you're net positive $2,488 in volume of interest so far. If we figure that out based on the original $20,000, that means that you've had a 12.44% return on your seed money within 12 months. Now, if we stretch it out beyond 12 months, then obviously that's going to go down if you do no other loans. So I think it's like 7% if you take the loan out for the full term, you end up paying off the credit card, and you end up paying off the vacation in a couple of years as well. For those of you who are into the math and like the numbers, I'm going to put up a couple of slides here with the math, and you guys can pause the video and take a closer look at these if you want to. But remember, high velocity of money is usually associated with a strong economy, while low velocity of money concurs with recessions and depressions. The same is true when it comes to your personal economy. It's just a different scale. At Life Benefits, we specialize in designing and selling participating whole life insurance for clients who want guaranteed growth on their money while keeping high liquidity. Participating whole life insurance brings balance to your quest for volume of interest and velocity of money, so you can build sustainable wealth during your life and leave a legacy for your family. Give us a call at 702-660-7000 and see how the velocity of money can start working for you.